Hey, everybody, Kevin here again with another episode for you for the Real Estate Without Renters podcast. And of course, we're concentrating right now on a special series. So I've invited my friend and colleague, David Franicki, to join me with this because David is a longtime investor, very knowledgeable investor, and has been through cycles in the overall economy, been through cycles in real estate notes, and everything else. So he brings a lot to the table on this, and he's been doing a lot of research, sending me a lot of information, which I greatly appreciate as well. And we've got a lot to cover today. In fact, we're going to end things today with a bit of a case study. So we're going to introduce more of the real estate note side into this as to the practicality. So far we've talked about inflation. We went on to recession, things that are going to impact every asset class across the board, including real estate and real estate notes. Both Dave and I think the real estate notes are positioned very well for recession because of the way real estate looks right now. We have a lot of properties with equity. We've got almost all-time highs in certain areas. That may change. We're going to talk about that today, but that's a safety feature because everything we buy in the note business is security. It's secured by something, I should say, not a security. It's secured by something, and that something is real property. So whether it's vacant land, single family home, commercial building, whatever it is, we have a collateral value there to fall back on. So it does take a lot of our risk out of this equation investing, which is important to investors today because of wealth preservation. We talked about that on the first video. And then as far as wealth creation and cash flow, all of these instruments that we purchase do provide monthly cash flow. We talked about what may happen in video 2 with the inflation and with recession and the affordability. Are people going to start to default on their loan payments? Is that a risk that we face? And we talked about that quite a bit on the first couple of videos. And the fact of the matter is we have to be smart about how we work with people in this type of environment. And there's a right way to do it and a wrong way to do it. And we're going to have an actual case study at the end of this that will illustrate really both sides of that equation. So thanks for listening, everybody. And thanks for recommending to a friend. So if you belong to a meetup group or a real estate investment club, anything like that, please refer it to a friend and go ahead and subscribe. It really does help. It enables us to get a higher profile and enables us to do more and more of these. And we like bringing the information to you. So David, how are you, my friend?
I'm doing well, Kevin. How are you?
I'm doing just fine. I'm sure your holiday went well.
Yep. And it was cool this morning. I was able to hit the mountain.
Ah, man, you gotta love that. I don't have the mountain challenge like you do when you're hiking and I'm walking, but I've got the heat.
Yeah,
the humidity heat, because I know you got the heat out there too right now.
Right. Yeah,
the humidity's been brutal, but yeah, you've got it tougher than I do with the inclines that we have there. All right, Dave, let's go ahead and jump right in, because I'm going to go ahead and assume that everybody has already listened to a couple of these episodes. In fact, if you haven't, go back and listen to them, because we're doing this in a pretty specific order, and I think you'll enjoy the way that we've laid all of this out for you, both on the podcast, which you're just listening to us, but I want to remind you as well that if you do want to see these slides, and David and I are doing our best to help you visualize what those slides are, we are also uploading these in full video to YouTube. So you can go to YouTube, you can search my name, Kevin Shortle. You can look up Real Estate Without Renters, and you'll see a channel there, and just go ahead and subscribe to that. And that way you'll get notified when something comes on there. And again, we appreciate all of your comments if you'd like to leave one as well. So Dave, I don't think you need an introduction at this point. So let's talk real estate. So the note business is real estate adjacent, if you will. I like to say it's the opposite side of the same coin. If you're in real estate and you've ever borrowed money, you've been in the note business. You've been on the borrowing side. If you've ever lent money or did seller financing, you're in the note business on the lending side. So it really goes together quite well. And I think our most skilled people like yourself, have a good understanding of real estate, but also real estate notes and the relationship there. So the big question becomes, what if I own a note and the property values start to go down. What are your thoughts right now on everything that you've seen, Dave, about real estate prices?
They're starting to soften. The price reductions are becoming very frequent now, at least here in Phoenix, even though Phoenix, I guess, did second in the nation in terms of appreciation this past year of what, 27, 28% next to Tampa, maybe.
Mm-hmm.
But the days on market is increasing. At a local RIA meeting, everybody knows it's coming. Something's coming. They don't know what's coming. Out of a room of 80, there are only 6 quote unquote old pros that are coming out of the woodwork. The others have no clue what went on before in '08 or before. Mm-hmm. If you talk to the various folk, not talk to, but if you read a bunch of the stuff that's out there, some of them are basically saying what we're going to see is going to be '08 on steroids. They're going to go back 4 or 5 recessions and multiply that times 2. Pick your poison. It's coming. So you've got to prepare and don't get caught short like I have in the past.
Right. And it's awareness, and there's preparation involved, and an understanding that real estate values can and will go down. They have in the past. Now, I personally don't think we're going to see a big crash because we have a whole different set of circumstances here. But I think there'll be an adjustment. And as you said, all the indicators are starting to show that. And when you start to think in terms of interest rates are going up, that's going to cause buying decisions. People are going to back out. Property values are so high right now that people can't afford to sell their house and buy back in the same neighborhood. So people are staying longer in their current homes, and that's going to shrink the market a little bit. And I think that's why we've seen the property values still going up amongst all of this, because the market hasn't quite adjusted yet. I mean, things take time, and all the stats that we look at, we're always looking backwards, what happened back then. But I think we're continuing to see that because the supply still gets smaller until we see this adjustment where rates start to go up. And then all of a sudden people say, well, I can't afford to buy now because my payment's 20-30% higher than it would have been if the interest rates were at 2% or something like that. In fact, we have a chart on that, which I'm going to show you in just one second. Let me pull that chart up. Okay, so here's the chart that I'm talking about. And what this shows is the interest rate. They're looking at the 30-year fixed interest rate, comparing it with the 1-month change in annual home price growth nationwide. So clearly on the green line, when you see that start to jump up, and this is the latest data from May, by the way, because all these stats, they always look back on as to what happened. So the latest report is May, but we also know what's happened since then. So in May, they're showing the interest rate of just over 5%. So when you look at that green line, you have to cast your eyes to the left, and you'll see that that's just about 5%. That number is now approaching 6%. So it's gone up darn near a full percentage just in the last couple of months. And as you see that line go up, what you'll start to notice is at some point, all of a sudden, this 1-month change in annual home price growth starts to drop down. So that's the tip of the spear. That's when it starts to happen. That's why you're seeing overall nationwide property values coming to a stop as far as growth, and in some cases even starting to dip down. And that's where I believe Dave and I were talking about people backing out of sales, the real estate agents that have listings and going towards closing, and then the people stop, they look at the monthly payment because of the interest rate now, and they go, no can do, or I choose not to. I'm going to wait and see what happens, because it's very, very difficult, even for experts, to predict price valuation changes. We can see trends and all of that. We can go back and look, and there can be some projection, but I'll tell you what's more predictable than property values is going to be monthly cash flow. And that's the business that note investors are in, the monthly cash flow business. Because I can tell you right now, with all of my private clients, the people that I work with on a one-on-one basis every single day, I can't think of a single one that would be hurt financially if property values drop 5%, 10%, even 20% because of the way that they invest in these assets to protect themselves. That is much more predictable. Even if things go wrong with the cash flow, we can fix it. Dave, your thoughts on that?
Yeah, I agree with you, Kevin. If you're buying right, and by buying right today, I mean if a property's worth 300,000, whack off or remove or assume it's worth 80% of that on your using your metrics, and then go 65% of that, and you're not going to get hurt. You're going to be very well covered. So you got your interest rate covered. So even if your payer goes south, which they could be because of what could be happening with the economy, that's everybody's got their own opinion on that. But we're going to do a case study that's going to show what can happen. So you've got to cover yourself. But if you've got the equity spread, you're good to go.
Yeah, you made a good analogy before about the walls, kind of squeezing in, right? So we're feeling pressure from multiple sides here.
Right. So if you're in a room and you have two walls, left and right, the one on your right is property values. It's compressing. The values are going down. The one on the left is the payer and his ability or her ability to pay because of inflation. So as one is going in, the other one's going in, you're in the middle. But if you've got that buffer, you're okay. With the payer, you can work out of that, and we'll be talking about different structures on that. But when you're putting this cake together, you can cover yourself on one major aspect, and you can cover yourself on the other by qualifying the buyer and do a what if situation. What if? Worst case scenario, the black swan event, the anomaly. It all can and will happen with the way the economics are going now. That's my personal opinion of what I've seen everywhere. And Kevin, I think you might agree with that because we've both been caught in that vice before.
Absolutely. And so buying right becomes so much more important, and there will be no doubt about it, because I've seen this happen with real estate agents. I've seen it happen with mortgage brokers, stockbrokers, bank employees. When the market changes, there's a shakeup, and the people who really don't know what they're doing, they're exposed pretty darn quickly. I've just seen it over and over again, and the investors in traditional real estate, the investors in the note business are no different than the other parties that I mentioned, where they've got to be prepared and look at these things a little bit better. They have to know more about it. It's one of those things where you've seen this as well. When real estate is booming, everybody's investing in real estate, everybody's making money, because you can make mistakes and fall forward and fall into money. When the market changes, boy, that's when all of a sudden the investors who were getting buys simply because of a market condition and not of their knowledge base, they get hurt. So you have a good case study on that of, what does happen if these walls start to squeeze in, and it affects you because it affects one of your clients.
Correct. So Kevin, in this particular case study, I did a mailer maybe a month and a half ago, and I did not get that many calls. So this is one of the calls that I did get. So this asset is in Abilene, Texas. The seller.
Let me just clarify. So for those who are fairly new to the business, one of the ways that you can find notes above and beyond some of the more obvious outlets like online and that sort of thing is you can buy a lead list of people who own notes and send out direct mail, and you find some pretty interesting notes in doing that. So it is another way of marketing your business and building upon it. So go ahead, Dave.
Correct. So in this particular situation, there was the seller who owns a car dealership, and I was contacted by his gal Friday, his assistant. So I never did speak with him. But, it's just in sales, you want to get with both parties or the primary. I never could get through that door, the gatekeeper. So in this particular asset, you can see the values there from realtor.com to e-appraisal. That's today. Now, that's okay for today. But when this loan was originated, which was back in the late 07, 8, 9, 10, whatever it was, the selling price was 65. but they financed 58.5. So there was not much of a back door there. Now they picked it up because the economy was going up. That's all cool, but it wasn't there. So this particular payer, she works at Lowe's. COVID hit, she was laid off. She was really stellar. So the lender was a member of the Bleeding Hearts Club and said, oh, we'll help you. So what they did was defer all the payments for a year. Now at 6% interest, what's your yield on that note? And then they picked it up the following 6 months or year, where we will lower your monthly payment to $400. And we, the lender, will pay the escrow, which was taxes and insurance, which came out to roughly $1,500, $2,000. So now look at your yield. So they wanted to sell the note. So they were doing, go ahead back to your sheet where you were, Kevin, that was good, on the amortization.
Okay, great. Okay.
So that's their record of what they were doing. You can see what they paid, what they modified, going down to payment 39 and no payments again and whatever. So this is all done verbally, a no again. So then
so the payments, regular payments, she's working, basically COVID hits, loses job, or at least the majority of the hours. And so you reduced her payment down to 400.
So they reduced the payment down to 400.
Okay.
That's principal and interest. And then just everything else was added to the back end. Mm-hmm. So the real unpaid balance was 52. And it should have been 38. So when I first talked to this seller, they said the balance is 38. Well, something doesn't match up here when you run your numbers. So they said, oh, no, we forgot. Well, I don't know if they conveniently forgot or if they did forget. So the net is it makes a big difference when you as a buyer, you're going to work on this. So I'm working through these numbers. I'm thinking, how am I going to resell this? How can I recast this? So I could go through on what Kevin talked about was the Texas hardest hit funds. But I'm thinking, this is just a challenge. I don't see this. If the economy gets hit again, this lady's going to be gone. Do I really want to add that stress that on here? And my sense was that the lender, the owner of the note, wanted to get par or wanted to get $52,000 for the note. I'm thinking, why would I ever want to do that? So that's the dynamics of this. I eventually walked from this particular transaction. They may come back to me, I don't know. And he owns a bunch of notes. But if he's a member of the Bleeding Hearts Club, this is business. And yeah, you don't want to just kick people out. But I am not a charity. I'm an investor. I'm here to make money. It doesn't work. Kevin, you want to add to that? Maybe you can, I skip some things that you might want to interject into the conversation.
So this is a note that you were looking at buying, not you hadn't purchased. That's and correct. As a part of our research, everybody, we look at things such as obviously payment history. We verify paperwork. We establish approximate property value. So there's a series of things that we go through in evaluating these, and that's what lowers your overall risk in these deals. Because if the property is worth $100,000 and you're buying an asset here for something less than what is currently owed, which shows around $52,000, meaning I'll be in this for less than $50,000, it's worth $100,000, I can check that box of risk. And that gets back to my point of, if property values go down, your investment is still safe. Because worst case scenario, and hopefully it won't come to this, but this investor could foreclose upon the property and either get paid at a foreclosure sale or somehow end up with that property. So from a safety standpoint, we're all good, even if property values go down. So that's, to use your analogy, that's one of the doors, right? That one we're okay with. That can come at us for quite some time. And let me tell you something, if that property drops down to $50,000, we have a lot more problems going on, than property values going down. So that would be a dramatic fall here. So the other wall, to stay on that same analogy, is we do have a borrower here that was affected by this. And a lot of people are. Now, one of the smart things I liked about this, that the current note owner, not you, Dave, but the current note owner did was they temporarily gave relief to this person in the form of a lower payment. So they knocked off $240 per month for that person. What I'm saying I like about that is they didn't do what the banks did for 2 years, pushed by the federal government with those forbearance plans of saying, okay, no payments for 2 years. That's a horrible solution to a problem that a borrower has in paying. You have to get them in the habit of making regular payments. Otherwise, the habit becomes making no payments. And when they're making no payments for 2 years, it's hard for some of them to start that engine back up. And that's what we've seen in all the statistics and everything else here. So they're making this $400 a month payment successfully. So you were looking at that and saying their balance should be a different number than what the current note owner calculated, right?
Yeah, but see, it was even going south further, Kevin.
Mm-hmm.
They reduced the P&I, the principal and interest, down to 4, and then they said, "Oh, we'll just forget your payments for 6 or 8 months." You can see the lines there, starting at payment 46 and dropping down the page.
Oh, so they did drop to no payments.
Yeah.
Oh,
yes.
Wow.
So you put all that together, and you think, okay, so I could take this over if I could buy at the right price. And the way I'm looking at this, I wouldn't want to pay any more than 15 grand for the note.
Mm-hmm.
So, because then I could go to hardest hit funds. I could pick up the difference between the 38 and the 52. In terms of 38 is what should be the unpaid balance, and 52 is what it really is. So I could pick that up from the hardest hit funds, and then I'd be into it for almost nothing. But I'm thinking I've already got several of these in that scenario where I'm working with hardest hit funds. And I just didn't want to add another one to that box in my IRA. My IRA was the owner. I just didn't want to go there. Mm-hmm. And also in the paperwork, they never really specified that the payer was paying taxes and insurance, but they said, oh no, they just do it. So I'm looking at modifying everything, and I don't want to go there. That's just my risk tolerance, where I want to go in today's market. I want something more quantifiable.
Right. But you would go there at a price.
If the price is right, sure.
Of course.
Just like the other note that we talked about before, I think, in Kingsville, where the unpaid balance was 49, I'm going to be getting 8 or 9 from hardest hit funds. I paid 15, so I'll be into it for what, 3 or 5? Mm-hmm. It's like, that's a no-brainer. And the house is worth 100. So you have to weigh these things. I do that all the time, maybe to my detriment, but I weigh them. What is the worst case? What's the best case? Does my greed overweigh, or is my greed overtaking what my risk tolerance should be or not? That's what every investor has to do, I think.
Yeah. So you had a note that went from good to not so good to bad. When they went to 400, again, I think that was a smart move, as I said. But then to completely say you don't even need to make the $400 a month payment for X number of months here, not a good move. Now, is this showing that they started making payments again, or is this projection?
No, they picked it up again.
Okay.
And then come January, quote unquote, they're going to go back to the 640. Well, okay, that's what they're saying verbally, but that doesn't mean anything. If it's not writing, it doesn't matter.
Yeah. Now, the other thing, when you're looking at a loan like this, everybody, you have to, again, evaluate your risk and rewards here, as Dave was indicating on this. So we can see a fluctuation in this, and that's great. They got them paying again, but I guarantee you're completely correct. Any servicing company would look at this and they would have to know what the exact balance is, and they would have to have the borrower even acknowledge what that balance is, because this is not done correctly, to come up with what the exact number is. And really what you'd have to do is go back and look at the mortgage, which will typically say any late fees are paid towards interest first, escrow accounts and all that. And principal balance is pretty well last. So that would be something that would be done in discovery, if you will. But the whole point of this is that you're mitigating your risk, and you're saying not so much concern, with that property valuation, because of the equity within this, it's more about the borrower and what can we do to get them paying again, which it sounds like it may be on track for that. But at some point, there is a price where you'd be willing to do that, because you may have to work with a person to go in with the understanding of that predictability. Okay, so I was talking about that predictability of cash flow there. Again, the 400, I would have probably lowered if needed be to maybe 300. I wouldn't have completely cut it off. But when you go back and look at that, even the pattern there, it went from good to not so good to bad to working again. Property valuation models, is going to be more challenging to take a look at moving forward. So I think that makes the most sense in working with people. And when you pay such a minimum price for this, the other beauty of this is you can work with people. And I think that's a part of this business that a lot of people forget. If this was a bank who's collecting those payments, in today's environment, maybe they would have done a forbearance plan, but those things have ended. And what we have seen is foreclosures have gone up again. People getting into the foreclosure process, I should say. The actual sale of foreclosure is a different story, but the number of people going into the foreclosures is on a big upswing, because banks, they have to look at their bottom line numbers, because they get penalized for holding on to these assets. And if they can't get a workout, they've got to sell it. I mean, just the financial pressure that they have from the Dodd-Frank Act. So with us as an individual note investor, if you, Dave, bought this note, you would do what you could to work with this person, but at the same time, carrot and stick, right? It's like you can't stay in that property for free forever. We get it. You've got to be able to make something, and I'll work with you.
So
and that's a good socially conscious thing, because otherwise this person would have been foreclosed upon by the bank, and they're done. With us in our business, it's never to kick somebody out of their house. It's to work with them to the best of our ability.
Yeah, and if I had moved forward with this, I would have required a payer interview at the end, like Fanac does, to see where, number one, I want to find out where the payer's attitude is. Number two, I want to find out about the job stability, what's going on in her life. And that could really make or break my last due diligence check mark, so to speak, because if that stuff doesn't match up, I'm out.
Yeah, because the bank would have a hardship letter. In a hardship letter, this borrower would explain, here's what happened, COVID, and I lost my job. I'm working again, and then I got injured, and now, whatever the story is. And then moving forward, what's the likelihood? So it's in their words, and you're just saying do that on a verbal basis to really find out the story, which I love, because you've heard me say this for years, and all of the trainings that I do. This business, to truly master it, and this is a good illustration of it, is it's not just numbers; it's the numbers and the story. And if you're an investor, especially moving forward into this economic environment, if you just focus on the numbers, you're going to miss some things.
Oh, yeah.
Okay. And hopefully they don't hurt you that big, but they can. If you just go by the story and don't know the numbers, same thing. You're going to get hurt in the business. It's understanding all of those, both sides of the equation here, because there's people behind real estate. There's people behind notes. What's the story? Do the numbers match? Do the numbers match me? Because once again, I'm using that analogy of a scale. You're weighing this note out and the probabilities, and then you make an investment decision, and that's going to keep you safe moving forward.
Let me add one more thing on this, Kevin. If you're buying a note from a hedge fund or a large player, they're not going to allow you to talk to the payer. It's just not going to happen. Mm-hmm. And a private seller, you can. So the part of the interview really gets back to basic sales. God gave you 2 ears and one mouth, and use in that proportion. You want to listen to what they're saying, and not just to what they're saying, but what's the tone behind all that. It's a make or break situation.
Yeah.
I'm looking for the attitude, the mindset.
I agree with you. And I would say in today's environment, if your research takes you a little bit longer, and perhaps you missed out on something, or you feel you missed out on something, so be it. Stick with your goods, stick with your discipline on these things, because we do have what could be rough waters ahead. And it doesn't make sense to get overly aggressive on something just to close a transaction, because we talked about, I think it was in the second one of these, the opportunities that come out of recession, the building process. Again, there will be opportunities there for sure. It could possibly be another great chance to create wealth that only comes around, every decade or two.
This is going to be a 50-year opportunity. I want to end with this too, Kevin. So we had Howard 10 on here, a few interviews ago, right? Mm-hmm. So I was speaking with him yesterday. His comment was, I said, Howard, all these cats are buying all this stuff. I can't buy it. Doesn't make any sense. He says, Dave, sit tight, follow your gut. You've got the stripes on your back. Opportunities are going to be flying at us in the next 6 or 8 months. And you will more than make up for and probably buying some of the assets from the people that are out there flying right now. And I thought that was a lot of wisdom, really great wisdom.
Mm-hmm. And real estate investors, for those of you listening to this podcast or watching this on YouTube, if you haven't started studying notes yet, let me please encourage you. I read something the other day. Blackstone, BlackRock, I always get those two confused, but the one who's buying real estate, I think it's Stone. They are stockpiling cash right now with an eye on buying more properties. And when they are your competitor, they've got an unlimited checkbook. They've got trillions of dollars under management. They have a bigger unlimited checkbook than you. They're going to pay prices that are higher than you. If you have the financial side of this business, which is the note side of this business, you will see more opportunities. You will not be competing with those big companies, because you just can't compete with an organization like that that's just going to come in and buy every single piece of real estate. They don't care if they overpay a little bit. They'll make it up in the long run. So make sure to become a complete investor. So notes is just the same or the opposite side of the same coin of real estate. You got real property and you got paper, and you know those two marketplaces, you can do very well.
Kevin, have you ever heard the acronym CYA?
Sure.
That's what we're talking about.
You got it. All right, everybody. Thanks for listening. Thanks for sharing with a friend. And if you're coming out to any live events, anything like that, please come up and say hello. And look forward to putting together another episode for you. We're working on it already. Take care.
Talk later. Thanks.